Hello everyone, welcome to today's US Open live webinar. It is Thursday, March 23, 10 minutes before Wall Street opens. I'm your host, Nikos Zabouras, Senior Market Specialist at FXCM. Of course, the main news is the rate decision by the Federal Reserve. It hiked them by 25 basis points yesterday, but appeared dovish and actually now anticipates one more hike and we're done. Whereas today, the Bank of England also hiked by the same amount and probably didn't have much choice due to the reacceleration in inflation as yesterday's data showed. Now, before we get into all of that, as always, please read carefully through the risk warning and the disclaimers. As you are going through the disclaimer, let me just point out that anything that is discussed in this webinar does not constitute investment advice and should not be construed as such. Okay, so let's get the ball rolling. We have Euro USD on our screen. Let's remind you that the US Fed hiked rates yesterday but made a dovish shift to its statement and kept the median terminal rate at 5.1%, which implies one more move of a quarter percentage point before pausing. Meanwhile, on the European front, we got another round of hawkish commentary by ECB official over the last couple of days and today, whereas if we look over at the old Albion, we saw that the Bank of England also raised rates as the reacceleration in inflation probably did not leave room for anything less. Let us remind you that this week's data showed that headline inflation broke the recent 3-month decline streak and rose to 10.4% year over year, while core jumped 6.2%. Okay, so let's now move over to Euro USD and talk a little bit more about the Fed and how it stacks against that of its European counterpart. So the Fed adopted a more conservative stance due to the banking rout and the stress in the financial system. It believes that these developments will create tighter credit conditions and that should weigh on inflation. And Chair Powell actually said during the press conference that this would be equivalent to a rate hike or more. So essentially what he says is that the stress in the financial system and what that will bring will do some of the work for the Fed. As such, it softened its forward guidance, now anticipating that some additional policy firming may be required, and I stress some and may, in order to achieve a sufficiently restrictive policy stance. That's a clear dovish shift from the previous ongoing rate increases reference of the previous policy statement. This dovishness was also evident in the summary of economic projections, where officials maintained the 5.1% median terminal rate forecast, which suggests one more quarter percentage move. At the same time, officials now expect higher inflation in 2023 and lower unemployment. So that for me is a clear dovish bias, because if you expect that inflation will rise, you upgrade your projections and you downgrade that of employment. If anything, you should actually raise the terminal rate as well. Let me also remind you that you can find more into the Fed's policy decision or your respective FXCM Insights websites. Now, let's compare that now with the European Central Bank. After the policy decision by both, the policy differential has widened again in favor of the common currency. There is a clear distinction here between what the ECB said and what the Fed said. There's a divergence, let's say, because the ECB president said that there is no trade-off between fiscal stability, financial stability, and price stability. And persisted on this point this week, which what essentially they say is that we have a job to do, bring down inflation. How do we do that? With rate hikes. Stressing the financial system is a completely separate matter, and we won't stop hiking rates in order to not put stress on the financial system. If that happens, then there are other tools to address that. The Fed, on the other hand, we saw that took into account the banking route in order to moderate its approach. So we have a hawkish ECB and a dovish Fed at this stage. And this hawkishness by the ECB was reasserted this week, both by Ms. Lagarde, but mostly by other officials, such as German banker and the Dutch banker, who both still see more moves ahead. So that, of course, is supportive of the Euro USD. You can see here, and let's actually also check out the hourly chart a little bit. So you can see the reaction here to yesterday's Fed decision, and it started with new highs today, but faces some pressure during the European session. So the pair runs its sixth profitable day, and that brings 1.1065 here in its crosshairs, although fresh impetus will likely be required for taking it out and pushing even higher. On the other hand, the move is overextended, and as we said already, we see some pressure today, but still in profitable territory. We can see further pressure towards the 200-period EMA here, but daily close below that level seem like a tall order at this stage. We don't see anything in terms of monetary policy, at least, to suggest that we could have sustained weakness below these levels, and in any case there are multiple support levels below that. So the outlook here is in favor of the Euro USD, even if we do need some pressure, given the downside pressure, given that the move is overextended. So that's it for Euro USD. Let's move over to GBP USD. You can see here that the pair bounces around after the policy outcome by the central bank, the BOE. So let's see what we had there. the Bank of England slowed down its pace of tightening with a 0.25% increase, with 2 members dissenting in favor of a pause. That was the 11th straight hike and smallest in nearly a year. Once again, officials did not shut the door to more tightening, since they repeated that, and I quote here, if there were to be evidence of more persistent pressures, then further tightening in monetary policy would be required. Officials also acknowledged that CPI inflation increased unexpectedly in the last 3 days. We talked about that, but it remains likely to fall sharply over the rest of the year. That according to the BOE again. And of course, the labor market has remained tight. So where does that leaves us? It leaves us to a constructive outlook for the GBP USD. Which brings the resistance at mid 124s in the spotlight. But we are cautious for further tightening, and let's move over to the 4-hour chart for more gains. My apologies. Now we're not sure it can go much higher than that. On the other hand, we can see a slide back towards the 200-period EMA at around 1.21, but a catalyst would be required for further slide below this region. And now, as we're already 2 minutes into the US session, let's shift gears and turn to the Nasdaq. The technical outlook has not changed much. The tech-heavy index saw volatility, and we can see it on the hourly chart as well, saw volatility around the Fed decision. You can see here that it initially strengthened to new 2023 highs, but then it dropped quite substantially and ended Wednesday with losses. However, that drop is probably more the result of comments by Treasury Secretary Yellen, who said that she has not considered or discussed anything having to do with blanket insurance or guarantees of deposits. Now, as we said, the technical outlook has not changed much. Strong move today higher. The conservative policy path and reassurances by the Fed around the banking sector can help the index extend its gains. Powell, after all, said that there was ample liquidity in the system, and the banking system is sound and resilient. As such, bulls can push towards the resistance over here, 13,742, although this could prove elusive in the near-term moves above that. On the other hand, we can see a decline back to the 200-period EMA around 12,280, 12,230, but the downside is well protected. You can see here at the 200-period EMA, we also got the cloud and the ascending line from this year's lows. So a constructive outlook for here at this stage for the NAS 100 as well at this stage. Now, looking ahead, not anything as important as what we've seen over the previous days, but in any case, Friday starts with CPI inflation from Japan. Now the one that the BOJ tracks is the ex-fresh food one, and this has been above the 2% target for a while now. In January, it rose to new highs not since 1981 at 4.2%. Now, later on Friday, we expect UK retail sales and US durable goods. US durable goods had slumped 4.5% in the previous print, which was the lowest since March 2020 and the height of the pandemic. Other than that, we also expect a series of preliminary PMIs. So that's it from today's US Open. Thank you for joining me, and we'll talk again next week on Tuesday.